Did you know that nearly 95% of forex traders consistently lose money? That's a hard truth. But here's the thing. Once you master how to properly read market bias and understand directional flow, everything starts changing. In this video, I'm going to guide you through a no-nonsense, structured approach to mastering forex bias using ICT concepts. Plus, I'm giving you a sneak peek at an exclusive entry model I've been using in my own trading. Welcome back to the channel. Whether you're new to trading or deep in the charts, one thing is always true. Market bias matters. It's the backbone of smart trading. When you know the bias, you can align your entries, manage risk better, and ride real momentum. In this video, I'll show you how to spot bias using top-down analysis and reveal an exclusive ICT entry model that'll give you an edge. Let's get to it. What is bias? Market bias is simply the direction the market is likely to head based on price structure and liquidity. In an uptrend, price constantly moves higher, clearing old highs and rebalancing inefficiencies. In a downtrend, price aggressively breaks down, clearing lows and correcting imbalances. Consolidation, that's when price chops sideways, trapping liquidity on both ends. Your job is to identify the phase because each offers a different opportunity. Bias using top-down analysis. Now, let's get tactical with top-down analysis. You'll begin by examining higher time frames to grasp the overarching market sentiment, then progressively narrow your focus to pinpoint precise entry points. Here's how to visualize it. Monthly, weekly, and daily charts establish your long-term bias. 4-hour and 1-hour charts reveal intermediate movements. 30-minute and 15-minute charts provide a short-term perspective. The 5-minute chart offers granular precision. For those with more screen time and a commitment to staying engaged throughout the trading session, consider using 5-minute or even shorter time frames for your triggers. Essentially, you're synchronizing all these layers to construct a comprehensive directional roadmap. When all three perspectives, long-term, intermediate, and short-term, align, that's your cue to make a move. This structure gives us perspective. Higher time frames show macro bias, while lower time frames help time entries. It's like using binoculars. Zoom out to see the terrain, then zoom in to take your shot. Groups. Long-term trend, monthly, weekly, and daily time frames, long-term bias. Intermediate-term trend, 4-hour and 1-hour time frames, intermediate bias. Short-term trend, 30-minute and 15-minute time frames, short-term bias. Confirmations, 5 minutes and below time frames, precision. Grouping time frames like this gives you a clear vision of market pullbacks and the continuation of directional trends. This allows you to adapt to different trends as market prices change. Order flow and fair value gaps. Let's talk order flow. Understanding how price moves helps you track the smart money. One of the strongest tools for this is the fair value gap, or FVG. Here's how it forms. Candle 1 creates a wick. Candle 2 drives price with momentum, creating displacement. Candle 3 opens beyond Candle 1's wick, leaving a gap. That space between Candle 1 and Candle 3, that's your fair value gap. It shows imbalance. Price moved so quickly it left unfilled orders behind. Smart money often returns to these gaps before continuing. In bullish trends, look for buy-side imbalance or sell-side inefficiency. In bearish trends, look for sell-side imbalance or buy-side inefficiency. These fair value gaps don't just mark order flow, they forecast it. Liquidity, internal range liquidity and external range liquidity. Liquidity drives the market. ICT teaches us the interbank price delivery algorithm, which shows how price seeks liquidity both inside and outside a swing leg. Internal range liquidity is the liquidity within the current price move. It includes FVGs, order blocks, and mitigation blocks. External range liquidity. External range liquidity is the liquidity resting beyond current highs or lows, old swing points, and external targets. When price retraces into internal range liquidity zones, it's hunting short-term liquidity. But when it seeks ERL, it's aiming to run a high or low. Understanding which one is being targeted helps you stay on the right side of price. Premium and discount with PD arrays. Every price leg, from a major swing low to a major swing high, has a 50% midpoint. This divides the leg into a premium, above the 50%, and a discount, below the 50%. Institutions want to sell from premium and buy from discount. Simple. Use your Fibonacci tool to mark that 50% equilibrium, then locate PD arrays, order blocks, fair value gaps, mitigation and breaker blocks stacked in those premium or discount zones. That's confluence. That's where smart setups live. Identify the range. First, determine the high and low of the current range. Calculate the midpoint. Next, find the midpoint of the range using Fibonacci retracement to identify the premium above the midpoint and the discount below the midpoint. Use the PD array. Visualize the premium and discount areas on your chart to identify potential entry and exit points. By using the premium discount range and PD array, you can identify areas of value within the market and make more informed trading decisions. Optimum trading entry strategy. If you've made it this far into the video, you're in for a special treat. As a bonus, I'm going to share with you an advanced trading strategy called the Optimum Trading Entry, or OTE. This strategy is designed to help you pinpoint the best entry points in the market, maximizing your potential for profit. To make things even easier for you, I've included a downloadable PDF guide and Notion template of this strategy. You'll find both links in the video description below. So, let's dive right in. The OTE strategy is based on the concept of retracement levels, specifically the Fibonacci retracement tool. Here's how it works. Identify the trend. First, you need to identify the overall trend in the market. This could be an uptrend or a downtrend. For this example, let's assume we're in an uptrend. Draw Fibonacci levels from the swing low to the swing high of the recent price movement. This will give you key levels where the price might retrace before continuing in the direction of the trend. ICT Fibonacci levels for OTE setup. To use ICT Optimal Trade Entry Pattern, you should set your Fibonacci retracement levels to the following as used by ICT. 0, first profit scale, 0.5, equilibrium, 0.62, OTE level 1, 0.70, OTE level 2, 0.79, optimal trade entry, 1, 100% retracement level, starting position, minus 0.5, target 1, minus 1, target 2, minus 2, target 3. Symmetrical price. Focus on the OTE zone. The OTE zone is typically between the 61.8 and 78.6% Fibonacci retracement levels. This is the sweet spot where the price is most likely to reverse and continue in the direction of the trend. Look for confirmation. Before entering a trade, look for additional confirmation signals such as candlestick patterns, volume spikes, or other technical indicators that support your entry. Set your entry, stop loss, and take profit. Once you have confirmation, set your entry within the OTE zone. Place your stop loss just below the swing low for an uptrend or above the swing high for a downtrend. Your take profits should split into different targets, of which target 1 is minus 0.5 Fibonacci level, second target at minus 1 Fib level, third target at minus 2 Fib level. And there you have it, the optimum trading entry strategy. The OTE strategy is a powerful tool to add to your trading arsenal. Don't forget, the PDF guide and Notion template are available in the description below, so you can implement what you've learned right away. I'd love to hear your thoughts on market bias and any ICT strategies you use to identify trends. Drop your comments below, and don't forget to check out my other videos for more Forex trading tips and strategies. Until next time, happy trading!